I think we are in a big transition away from an ultra loose, indulgent kind of arena where people are suddenly going to have to be a lot more discerning with their capital. And I think it's going to cause a lot of people to be much tighter with their investments. And I think that's going to increasingly lead to a lot of markets, stocks, bonds, and countries really feeling a pinch here and facing some headwinds.
So what exactly is a zombie company? How do you define it?
Zombie companies are firms that are burning a ton of cash and don't have a lot of cash on the books to sustain that burn for very long. And by very long, we mean, the most we're looking at is 24 months. Most of the stocks on the zombie stock list have less than 6 months of cash to sustain their current burn rate. And the other thing we like to look at too is the interest coverage ratio. That's where the companies aren't actually generating enough pre-tax profit to cover their interest expense. These are businesses that are just, they're in a really bad position with respect to their current financials. They can't pay off their debt. They're probably not going to get more debt because they've been losing so much money. And the last component, Adam, is a poor competitive position, right? There's no problem with a company being unprofitable. The problem is if it really doesn't have a business model that will ever achieve profitability. And a lot of companies on our zombie stock list, well, they all fall into those three categories, but we've seen a lot of companies, I think in general, especially companies that went public in 2021, probably never deserved to be public companies. And it was really only this ultra loose monetary and fiscal policy that allowed them to come into being.
Okay, so we've seen that in prior cycles where too loose standards basically result in what the economists call malinvestment, right? Which are basically projects that don't deserve the funding that they get. Sounds like you think we are back at a stage where there's a number of these companies that could probably be well described as malinvestments. I guess first, let's just start with the scope. How many of there are these? I've heard percentages bandied around, and in doing some research for this interview, I actually found they were all over the map. So what sort of percent of the corporate fleet do you think fall into the zombie umbrella?
I don't have a percentage off the top of my head, Adam, but I know when we ran the numbers in terms of the companies that didn't have enough cash to support their cash burn for 2 years was around 250 to 300 companies. And those are all the major publicly traded companies. We're not talking about penny stocks or super low market cap companies. These are all companies with typically $50 to $100 million of market cap at minimum, plus average daily trading volume of more than $1 million. So it's a large number of companies for sure.
We are currently in a market that is trending downwards. Has been trending downwards for the year. You made a really good argument that we're entering into recession here. So could there potentially be a material number of companies that join the zombie fleet as the year progresses?
Possible, yeah, absolutely. Like if you see the economy lose steam and there's just less money being spent in general, I mean, that could be for sure. I mean, the pre-zombie thing is a little bit tough because, cash flow is cash flow at the end of the day. So if they've been generating cash flow or they have a huge runway of excess cash on the books, right, to support cash burn, that's not going to change too dramatically. But I think, look, as every month sort of ticks along and the economy's not doing that well, all those firms that were at 25, 26, 27, 30 months of runway, they may come onto the list. And to be honest with you, I haven't looked at how many companies are actually have enough cash for 24 to 30 months. Those potentially could be pre-zombie because every month they continue to lose cash, they would potentially be being added to the list. But I honestly haven't looked at that. That's a good idea though.
One of the things we talk a lot about on this channel, besides the recession risk I just mentioned, is margin compression. There's a lot of profit margin compression that's going on right now, and the trends for that don't look very encouraging. In other words, it looks like market margins are going to compress even more going forward because of higher inflation, higher input costs due to inflation, because of raising cost of capital, and because potentially of falling consumer demand. And so I got to imagine if companies that aren't zombies yet, but aren't doing great, as they begin to get hurt more and more on the profit side, maybe they start burning through enough of their cash reserves that they fall into your not enough runway to make it through the next two years at this current burn rate?
Yeah, absolutely true. I mean, there were a few firms that I kind of thought would be on the zombie stock list because I know they burn a lot of money, but they have a ton of cash in the books. So we're like, well, they could be around for a while. The zombie list was meant to really identify things that were in dire straits. Peloton's a great example. I mean, just a couple of days ago, I think the CEO mentioned that they got 6 months to figure out whether or not they're going to live. They're laying off another 500 people. We put them on the zombie stock list at the beginning of June. So I think we gave people an additional amount of warning. We warned about that stock and put it in the danger zone even before its IPO. And I think one of the key hallmarks about zombie stocks to keep in mind, Adam, is really, it's a bad business model. Like Peloton really never had any business being a publicly traded company. I mean, there's really not anything special about a stationary bike with a screen on it.
With an iPad on it, basically, yeah.
Yeah, that's right. I mean, there's not enough competitive differentiation there for them to sustain positive margins, and a lot of factors kind of came together to make it seem like it was better than it was. Not the least of which was an ebullient IPO market, which can make anything look good. But yes, I agree with you 100%. Like the idea that there are going to be more zombie companies coming out as the economy worsens is 100% true. I mean, it's. A lot of these companies were birthed into existence because we had a better environment than really was sustainable. And as we go into one that's probably a bad environment, it's going to be even harder to sustain poor business models. We've seen that with some of the zombie stocks already who've recently had to borrow money, and they've been borrowing it at rates, double, triple, quadruple what they've been borrowing in the past. And that still spells doom. I mean, it puts off the inevitable, it feels like, for a little while. But if you're not making money and you had to borrow money and you had to borrow at a really high rate, well, your burn rate's going to be going up. Probably not down,
right?
Because you're a bad business model. And so
how many of these zombie companies could have existed the way they have over the past number of years if it weren't for the central bank's policies of flooding the world with liquidity and intentionally driving the cost of capital, the cost of debt down to historic lows, from what I've heard. I mean, lows that are like not seen in hundreds, perhaps even thousands of years, and some people have said.
The Federal Reserve and the US government, for that matter, to really minimize risk of investing to the point where we've seen what I would call rampant and really reckless speculation.
What implications, if any, do you think that's going to have for the markets?
That kind of gets back to your earlier question. Is this going to be, a slow drip kind of die-off, or is there going to be some kind of catalyst that leads to a big sell-off? I think the Fed may have a difficult time avoiding the big catalyst, and I think it can come from a variety of areas. I think, look, if Bitcoin were really to see, a lot more downside risk, I think that's going to hurt a lot of pocketbooks of speculators. Mm-hmm. And when speculators lose money in one spot, they got to sell money in another spot, and that creates a contagion. We're perilously close to that in both the stock market and in the crypto market. And so one of the things, honestly, I think, Adam, that could precipitate this is, a big, maybe the original meme stock, Tesla, and what's going on with the Twitter deal here. And if Musk is, and it looks like he will be forced to close at $54.20, how much Tesla stock he has to sell, right? And what that does to that stock, and what kind of contagion that creates in people's losing money, and then having to then find other places to raise cash to pay their bills because they're so levered up.
Is the economy going to feel it or ignore it?
Yeah, no, I think the economy will feel it for sure. I think you bring up a good point that there will probably be a lot of people out of work because of this malinvestment. And that's another place. Like, it's not just malinvestment of capital, Adam. It's malinvestment of people, right, and time they've spent doing things that could otherwise have been spent to build a better career, or have a better job, especially for those people who decided to make day trading. And what we've lost is really the value of the capital markets signal, which is, hey, this is a good business versus a bad business. Without that proper pain signal, we're not really able to operate efficiently as a market, as a society, in order to thrive in the short, medium, and long term. And for now, the Fed has dumbed our senses in terms of what's speculation and what's investment. It's going to take a while for those senses to come back. They won't turn on overnight.